Hello, all. I hope you are well today. Well, I'm gonna explain this problem. The problem is problem 10, number 2A. I was not able to find the problem in my homework, so I'm not sure if the answers are correct, but I hope they are. I decided to just add the answers here to make this quicker because I just have 50 minutes, but I will explain each point. Okay, so let's see. The problem says Eller Corporation sells rock climbing products and also operates an indoor climbing facility for climbing enthusiasts. During the last part of 2017, Elter had the following transaction related to notes payable. September 1st says, issue a 12,000 note to Pipen to purchase inventory. The 3-month note payable bears interest of 6% and is due December 1st. Eller uses a perpetual inventory. As I remember, a perpetual inventory uses the inventory account. So in this case, since Elder purchased inventory, we are going to debit 12,000 here of inventory, and it was with a note payable, so we are going to credit note payable because this is going to increase our liability to 12,000. Okay, this will be our first the first transaction. We are not going to do anything with the interest in this transaction. Okay, the second transaction is on September 30, and it says record accrue interest for the Pipen note. So we are going to accrue the interest for this note that we had in the first transaction. So we are going to calculate the interest just for 1 month. We are going to accrue just 1 month because the transaction was in September 1st, but we are going to record the accrued interest on September 30, which is 1 month. Okay, this case, what I do to calculate the interest is divide the 6% by 12 because it's an annual interest, and then I'm going to divide also these amounts by 100 to remove the percentage, and then I'm going to multiply the note payable amount times this amount. So that will give you a 60 interest amount for 1 month. So each month we are going to pay 60 interest amount. In this case, we are going to debit interest expense, and we are going to credit interest payable because we still own this this interest, and it's going to be for 60. I hope this is clear. The next part, I'm gonna do this quicker because I already have 4 minutes. It says issue at 6,500, 8% interest for month note to Prime Bank to finance the purchase of a new climbing wall for advanced climbers. The note is due on February 1st. So in this case, in this transaction, we are going to receive money from the bank because we asked for that money. So we're going to receive cash for 16,500, and we are gonna own to the bank the same amount. That's why we are going to increase our liabilities, notes payables, by 6,500. We are not going to do anything with the interest in this transaction, also because we are going to do it until the end of the period or when we accrue the interest. Okay, which is going to happen in the next transaction. The next transaction says that on October 31, record accrued interest for the pipe note and the prime bank note. So we have to accrue this note for one more month and the interest for this notes payable for 1 month too, because we got we issued this note payable on October 1st and now it's been a month. So we are going to calculate the interest for this one. I'm gonna do the same. It is 8 percentage divided by 12 because it's an annual. Then I'm going to divide this amount by 100, and then I'm going to multiply. I do it this way because I think it's easier. I don't know, for me. And I'm going to multiply this one for the notes payable amount, so it's 110. And I'm going to sum the interest for the pipe note plus the interest for the prime bank note. So we had 117 interest expense, and interest payable is going to increase our liabilities because we are still on the interest. Okay, the next November 1st says issue a 26,000 note and paid 8,000 cash to purchase a vehicle to transport clients to nearby climbing sites as part of a new series of climbing classes. This note bears interest of 6% and matures in 12 months. So in this case, we are just going to record the purchase that we did of the vehicle. In this case, it's going to increase our assets, equipment for 34,000, and we are going to increase our liabilities because we issue a note for 26,000 and we paid 8,000 in cash. So that's why we are going to credit also cash. For the next transaction on November 30, we are going to record it says recorded accrued interest for pipe note, the prime bank note, and the vehicle note. So we have to record the accrued interest for the 3 notes that we have open right now. We already have this amount. We already know the amount for this one, and then we have to calculate the interest for this note. So I'm gonna do the same. I'm gonna divide 6, which I already have. It's going to be the same percentage. Just I'm going to multiply. This case is gonna be this times this one because it's the same percentage. It's an annual. So I'm going to sum this interest for 1 month because it also passed 1 month since I issued the note for the vehicle, and it has been 1 month. So it's going to be this plus this plus this. So it's 300, okay, for interest expense, and interest payable is 300 because we still own this interest. Then the next transaction, it says paid principal and interest of the pipe note. So our note payable is already due, so we have to pay the principal amount, which is 12,000. That's why we are going to decrease our liabilities because we already paid it, so we're going to debit notes payable, and we're going to debit also the interest because we already going to pay the interest for 180, which is the 3 months, 3 months of 60. Okay, and we are going to pay cash. Obviously, we are going to take cash to pay this amount for 12,180. And the last one says record accrued interest for the prime bank note and the vehicle note. So in this case, we are going to record the accrued interest. So we are going to increase interest expense. In this case, we are going to sum just for 2 notes because we already paid the other one. This kind is going to be the prime bank is this amount plus this amount, which is the vehicle interest. So we have 240 for interest expense, and we are going to credit interest payable for 240. Okay, so these are all the transactions. With this, we already met the first request, which was prepare the journal entries for the transaction noted above. Next, it's post the above entries to the notes payable, interest payable, and interest expense. Accounts use the accounts. So it gave us a hint. The hint is 590 for the interest payable. So we have here, I have registered here the notes payable. We paid one, that's why we have one debit. That's why we decrease our liabilities. We got the first one was for the, it was for the pipe note. This one is for the prime bank finance that we received, and this one is for the vehicle. Okay, so we paid one, so we just own two. We just own these two. That's the balance. That's why we have a balance of 42,500. For interest payable, we also paid the interest for the pipe note, which is 180, and we still owned the interest for this. Well, we still own the interest for the prime note and the vehicle, but we are going to be accruing this interest. That's why we don't show like the total amount of all of the time. So the balance will be 590. This case, I just sum up the transactions, the movements we have for this account, and reduce the debits. Okay, that it decrease our liability for the interest. And there's the interest total expense. In this case, we have right here 770. Okay, I'm going really quick because I just have 1 minute and a half. So the next part of the exercise was to show the balance sheet presentation of notes payable and interest payable at December. And in this case, the only the balance of the account for notes payable was 42,500, and the interest payable was 590. So this is our balance sheet showing the balance of the accounts. Okay, and the last question is how much interest expense relating to the notes payable did ever incur during the year. In this case, it's going to be 770, which is the balance of the interest expense. So that's it. I hope I made myself explain. Sorry for the background sounds. I have a really noisy roommate, so they sing and they do everything. So I'm sorry for the noise. Well, thank you. I hope. Let me know if you have any question.